Hello and welcome to this webinar in association with HSBC Life, which will examine the economic background influencing taxation policy. My name is Lois Vallely and I am Chief Reporter for Money Marketing. And joining me in our studio today from Money Marketing Towers, we have Mark Lambert, who is Head of Onshore Bond Distribution at HSBC Life and is also a Chartered Wealth Manager. And we also have Tony Wickenden, who is Managing Director of Technical Connection and also regularly writes and presents on tax and trust issues. Thank you both so much for joining me today.
Good morning.
HSBC has just undertaken a project in association with Technical Connection, made up of advisor and consumer research and also a white paper on investable capital. And that is what we're going to be talking about today in this webinar. We'll spend about 10 or 15 minutes on the initial discussion and then we'll have 20 to 25 minutes for questions and answers. So any questions you have, please do type into the question box that you can see on your screen. Any questions we don't get through today, we will endeavour to get back to you afterwards on, so please do submit your questions. The white paper will be available for download in mid-December. So, Tony and Mark. The research and white paper take account of advisor and consumer anxieties and aspirations, as well as the economical and political context, and of course, taxation. Why do you believe that your 3 Eyes project and the insight it delivers is relevant in the current environment, and what are you hoping to achieve?
Right, certainly. So those of you who know HSBC Life have seen us in the last 5 years engaging out in the advisor marketplace around our onshore investment bond and all aspects of financial planning to do with that and the associated trusts. And more we were getting feedback from the advisor community about how difficult it was to put together relevant investment recommendations for clients across all asset classes. So as a result of that, we've been working very closely for a number of years with Tony at Technical Connection. We had a bit of a brainstorm, and as a result of that, we commissioned this particular report on investable capital and how taxation impacts investable capital and ultimately producing financial plans. From my perspective, it was very important that we had a guide that looked at literally all of the asset classes and tax wrappers that were available for investable capital in one easy to read and navigatable report. So we had this put together, and now we've got a report where advisors can go in, they can literally see a range of information around all of the asset classes and tax wrappers. It gives a snapshot of the taxation that impacts them for income and also capital growth. And what we're hoping with this particular report is that they're going to be able to use it as either a core revision guide for those people who deal with wealth management all of the time, but perhaps for some of the newer advisors into the industry or paraplanners beginning their journey, they'll find it something that's core as they pull together their clients' relevant investment plans.
Great. And what are the main findings of the research and the white paper?
Okay, so on the research, we also engaged an organisation called Adlusum, and they went out into the marketplace and they literally spoke to 200 advisor firms and also 1,000 end clients. On the advisor firms, it was firms that were involved in wealth management, and about 80% of their clients are either higher rate or additional rate taxpayers. And for the end clients, there was a minimum of them being advised clients and also having at least 25,000 of investable capital. And a lot of the clients had considerably more than that. A few things, we will be sharing this, but just a sort of snapshot. Unsurprisingly, there were levels of alignment. So what we found on considering tax effective use of assets, you had 98% of advisors saying that that was absolutely core in what they did for their clients. And for the end client, they felt, looking at taxation, 95% of them had it as either important or highly important. We looked at other areas around what sort of headwinds do people see, advisors and clients, around impacts on investable capital. And the core things that came up were inflation, taxation, concerns about volatility and global events. And again, they were very aligned there. What was quite interesting was there was a bit of misalignment is probably too strong, but they weren't together on the high scores for intergenerational planning. Lots of advisors will be aware that there was a report by the King's Court Trust a couple of years back that suggested over the next 30 years 5.5 trillion of assets would be sent between the generations, and advisors are right up there, I suspect because they're acutely aware of how taxation impacts intergenerational transfer. 96% of them said that was very important to them, but for clients it was about 76%. So still important for the majority, but on that we probably need to do some more research. We wonder whether it was because the end clients in this current environment are thinking, yes, I want my money to go to the loved ones that I want to get it tax effectively, but also I've got to be thinking of myself, my own retirement, my care needs. So there's a bit of a mismatch there. So that's a sort of example of the types of responses we're getting on the research.
Perfect. And Tony, I know you led the research for the white paper, so do you have any key points you wanted to highlight from it?
Yeah, definitely. Thanks. First, the two parts of that report, we were delighted to be asked to be contributing to this, so it's a subject dear to our hearts, effectively. So I love the fact that there were two parts to this, with the research of looking at, as Marcus said, clients and advisors to see where the challenges and opportunities lie. And I think there's something in that, as you'll see when you see the research, for both advisors with a greater recognition of what their clients are thinking broadly. Clearly they all know what their own clients are thinking, but broadly. And then also for product providers around what is important to advisors. Because I think that if we can concentrate as a sector on what's important to the people that we're speaking to and what we can control, and that was what brings us to that second part, then we're really in that sort of sweet spot where you've got a Venn diagram of what's important to someone and what we can control, then we can do something about it. And that's the something for an advisor, I think, is delivering alpha. The difference they make to the financial bottom line of their clients because of what they know. So we were just looking to help, really, to put in one place for easy reference, as Mark said, what you need to know effectively as a planner these days in relation to investable capital. So the research is one thing, and the part we contributed most strongly to, I think, is that so-called white paper. It's actually not so-called, and dismisses it so-called white paper. No, the white paper, where we're looking in depth at the economic context for taxation policy, as you mentioned at the top, Lois, and then the reference point to taxation and the relevance it has to the financial planning context. And as everyone will know, these days taxation has been pretty much front page news and is likely to continue to be, and then ramp up again as we get towards the next election. Because taxation, whilst it's not the most important thing to the overall investment planning process, it is important and is shown that making smart choices does end up with the client being better off. Statement of the obvious, I know. So we wanted to put in place that reference work that we will keep up to date. And by the way, when we wrote this ready to go, and the good news is that we thought we'd better just hold it back because it was a pretty febrile time. When is it not ever a febrile time in politics? So we've had 3 rewrites since, because we did it in the time of pre-trust, then trustonomics, then we've had the interim period, and now we have a kind of bit of stability.
But we shouldn't say that. Just don't jinx it.
Probably not. But here we are now, and we're committed to keeping it up to date as a place of reference for all things taxed in the context of financial planning.
Great. Can you give us some examples of what an all-asset approach to investing capital would look like in both the accumulation and decumulation phase?
If I start and then you
start,
yeah. So very much what we're saying, and this is a theme that we have broadcast in conjunction with Technical Connection over the last year to 18 months. What we're basically saying is, and no advisors do this anyway, but actually with the current taxation environment, it is even more important than it ever has been to consider all of the asset classes and their tax position when you're looking at achieving investment growth for the clients in the most tax effective way, and then subsequently getting cash out, funds out, most tax effective way, and then finally on the intergenerational side. I mean, we haven't touched on it yet, but obviously with this latest autumn statement from the Chancellor, you've got the scenario where the allowances have been frozen pushed further out till 2028. So actually, taxation is becoming a bigger and bigger thing and having a more and more of a drag on some of the investment scenarios that can be chosen for clients. So on the all asset, we're just saying, look at everything. In a lot of instances, I would suggest, as a most basic look for clients, advisors would be looking at SIPs, ISAs, general investment accounts as their three core wrappers, if you like. And we're just saying within our report, by the way, consider bonds more than they have been in the past, onshore, offshore, look at SEIS, EIS, VCTs, for example, the benefits of the taxation of pensions, and just think what is most sense, or what makes most sense about where you draw income from when you need to, and what structures you've got in place to send the money on intergenerationally. So that's what we're talking about when we suggest all asset approach, and that's what we hope that this report will deliver by being a core reminder of the taxation elements that impact them and how different it can be between capital growth and also income, the way taxation happens.
Yeah, I think it is really important. And I don't think we're trying to say, as Mark was saying, that this is revelational as an approach, because I think most advisors would generally think of taking account of all assets. In the sector generally, we've seen since pension freedoms, clearly people think beyond their pension when they come to draw money down or to save money up, because they do have money in different places. And it does we're just reminding and putting some sort of gravitas behind it, why it makes a difference to look at all assets and make the choices that you do, because taking full account of taxation. So that all asset approach, I think, is a kind of statement of the obvious around what to do, but a reminder of why it's important, and to give you the background, to give you basically the background to give the clients the reasons why you think this is the best way to go forward for them, taking account of all the tax changes that Mark has referred to that have been introduced even over the last year. And to the point of the autumn statement and the changes, at one level you'll focus on certain aspects of them, and that freezing of allowances at one level does feel, and that's why it's so powerful from a government standpoint, it's going to generate 25 billion a year more tax in a couple of years' time. That's how powerful that is. And we all know why the government needs more money, and it only gets it from one place pretty much, which is taxation. So the freezing of allowances doesn't feel too painful at the time the freeze takes place, but actually generates a lot of money. And we know it draws more people into taxation. The point there is that the more people that are drawn into tax, and actually more importantly, I think for advisors, higher rate tax and additional rate tax, the more people will want relief from that pain of taxation. That additional rate threshold not just being frozen but actually dropped is going to draw a lot more people into the additional rate of tax. It's going to stop the 40% rate of tax applying at 100,000 now, not 150, at £100,000, because we've got that crazy 60% rate up to 125. And then we've got the reduction of the dividend allowance by 50% next year, the reduction of the capital gains tax exemption by more than 50%, and then again the year after that. So you think, okay, are we getting overexcited because they're relatively small sums, 12,300 for the CGT and 2,000 for the dividends? But they absolutely need to be factored into decision making. If we're professional at our job, we need to factor them in. And by factoring them into that decision making, it does make a difference to the choices, I think, that you make, as it will for, with the non-NI changes and the reduction of dividend tax. And we've got that corporation tax increase. Factor all those into those decisions you make when you're advising a small business as to how to take the money out of the business. There are so many consequences that come from, on the face of it, relatively small changes in numerically, big percentage-wise. So I think advisors have a real job to do, a responsibility to take all of that into account, and actually a fantastic opportunity to engage with clients and say, you know what, this is something we ought to run a tax health check effectively, especially at this time of the year. So we're coming up to the end of the tax year, and more so this year than maybe any other year in the recent past, we should be looking at what should we be doing this year before it closes, because things are changing next year, changing in the way that myself and Mark have just touched on.
Yeah, definitely. Great. I'm going to go to some questions from our viewers now. So first up, Connor Byrne from Hottinger Group asks, are we going to find it impossible to realign investment due to political risk, in quotations?
Wow, That's a big one.
Who'd like to take that first?
I don't think it's impossible. I'm not an investment specialist, clearly, and I don't know if you have a view on that, but it's not impossible. This is what advisors do. They look ahead, look at what's going on, talk with or work with whoever they work with in designing investment policy, and then take a decision, really. Our report, just to put it in context, is not so much about choosing investments and investment performance, but more around the wrappers and the tax planning that goes around it, the overall financial planning process that takes place.
I was going to say, in terms of the political risk, I found it interesting in the report that you referenced that capital gains tax currently generates about 15.3 billion of taxation into the revenues coffers at the moment, and about 60% of that comes from business sales. But again, I think with the freezing of allowances, you're probably going to find that more of that 15.3 billion, well, more than 15.3 billion is generated, and more of it will come from investment assets, won't it? Because of that reduced...
Oh yeah, absolutely it will. And the fact we've still got business assets disposal relief is helpful in that sense. So I think the political point definitely has an impact on taxation policy, which in turn then has an influence on investments. But in terms of the markets, then that, as we've seen, has a life of its own and has a power of its own. Looking ahead with political aspects, and if we do have a change of government in a couple of years' time, then we could be set again for another sort of step change rather than an evolution in taxation, especially capital taxation. So I think there's a lot that this current Conservative government has done in relation to taxation that has kind of stolen in a way, or just aligned with the ideas of Labour in relation to taxation of dividends, of capital gains. So we were thinking that. But when it comes to capital, it's been left largely alone, apart from that CGT exemption reduction. I think one of the things we can look, I don't know if it's look forward to, but anticipate if we do have a Labour government, is that potentially harsher treatment of capital gains and harsher treatment maybe of inheritance. I think they're the two things that you would most obviously put at risk from a Labour government. I think everyone seems to be as one, Conservatives and Labour, in relation to a wealth tax. I think we can put that to one side.
Yeah. So we have another question from Harj Gill at Sandringham. What changes do you foresee on the taxation of bonds? 1, tax on growth deemed paid within the fund. 2, tax on income withdrawals. 3, use with DGT to help with IHT.
That's quite a question.
It's quite a detailed question.
I mean, I suppose it's obviously unknown what the revenue, the government will do. However, we did see with the increasing in the corporation tax rate that is coming up that there was no change in the taxation to underlying policyholder funds on the onshore bond. So there hasn't been a change so far, and there was nothing further in the autumn statement.
No.
Anything that you spotted?
No, and I think, and we can take some reassurance from that. We've had a long period of stability in relation to the taxation of both internal funds and bonds, and apart from some small changes, policyholder taxation on extracting money from the bonds. In fact, it's one of those, maybe not a lot of people know that points, but the well-known 2 things that really help when you take money out from an investment bond. And a great point made by Mark on that corporation tax thing is that internal funds, policyholder funds in life insurance companies in the UK are anchored to, the taxation is anchored to the basic rate of tax, not the corporate rate of tax,
right,
which protects it and continues to protect it from harsher taxation. Remember, I have to say this every time I talk about bonds, dividends are not subject to tax at all inside a bond, which is really important given the power of reinvested income. And that reassuring point is that, did you know top slicing relief has been with us since the Finance Act 1968. 1968, and the 5% withdrawal rule that everyone knows. Both of those ways of taking your money out can be incredibly powerful to extract money tax efficiently, but that's been with us since 1974. So that's been left untouched, and it has been looked at, but it's been left untouched. So I think we can take some reassurance from that. And in relation to that DGT point, as I said, we've had no substantial change to inheritance tax. Who knows what will happen in the future, but DGTs, as do loan trusts, continue to work very well for the clients when it's appropriate, not subject to any anti-avoidance legislation, not even disclosable under the disclosure of tax avoidance schemes regulations, certainly not loan trusts and DGTs also, provided they were in the market before, I think, 2019, under the established practice rule. So all in all, we have a very sort of a period of current stability. We've had long-term stability in terms of bond taxation and in relation to bonds in trust, basically. So I would say to that question, we're all good to continue going with planning with bonds and bonds in trust.
Right, great. Mark, did you have anything to add on that point?
No, nothing further.
Nope. I will go on to the next question then. So this is from IFA Quays Hamza, and I'm sorry if I got that pronunciation wrong. Intergenerational planning involves many aspects, from protecting capital against inflation to accessing cash before you give it all away, and then choosing the right trust and structure for the property if one spouse or civil partner passes. What trust and property structure do you recommend?
Wow, that's a big one as well, isn't it? Really, my answer is going to be very sort of, it all depends, as it does, and it goes to the heart of what advisors do well. Understanding what's important to their clients and their client situation, understanding what's possible within a tax context. And so it really does depend. So, you could go on and on with examples to go, if you want control over and access to the capital, then think about loan trusts and discounted gift trusts. If we're looking at investable capital as opposed to your house or your business, which is free from inheritance tax anyway. So it just depends. The flexibility that a discretionary trust offers is very powerful and we know works. When you're thinking of trustee investments, because of the tax aspects, bonds are the starting point because they are much simpler to administer. That's actually another really important point in relation to investable capital, is that let's not forget what those reductions, and I'm going off a bit of a tangent, but I think it's quite important, those reductions in the CGT exemption and the dividend allowance will mean in relation to reporting tax. And we all know what a pain it is to do your tax returns and have to fill something in. With those levels coming down, more people are going to have to report tax, either through their self-assessment return, and even if they don't breach those limits, which is sort of round about 50,000 in relation to capital gains and 10,000 in relation to dividends, you still have to report the gain or the dividend if it exceeds the threshold. So more people are going to have to tell HMRC about their tax. And that itself may be another reason for, is there a way I can manage that better, because I really don't like having to do that work. Not that I want to hide anything from HMRC, I'd just rather not have to do it. So to the question, I think it all depends, and it's basically advisors doing what they do best, of understanding their clients and then knowing what's out there and what works. And I think our white paper will help if you need any help in terms of just how does that work again? How is it taxed? Is it at risk in the future? That white paper that we've produced will absolutely put all that at your fingertips. So it all depends. And the wide range of solutions that currently work continue to work.
Great. Mark, did you have anything to add?
Just really, we're finding that loan trusts are being used more and more, whether it's part of the environment that we're in, where people are wanting to keep hold of their capital, but also wanting to start making plans for passing things on to the next generation. So utilising the loan trust where they have access to the original capital, but it starts to have any growth grow outside of their estate, be subject to the trust where it would be passed to the people that they want it to. So a mixture of being able to access capital still, have an income, but have control about what happens in the future. So we're finding loan trusts are really being used quite a lot in the current environment.
Yeah, I think that's true. I'd corroborate that. And I think sometimes loan trusts are undersold is the wrong word. It implies we're selling stuff, but actually underutilised. Because certain things get, they get the sort of flavour of the month taste, as it were, for a while, and loan trusts sort of have fallen away a little bit. But they do such a great job in terms of, their ease of running, the fact you've got access to the original capital, the fact that they're uncontentious from HMRC's standpoint. We're reassured in that. But when we look at the disclosure of tax avoidance schemes regulations, which is not about effectiveness from inheritance tax standpoint, it's just about what they want to know about. And they've just said, actually, don't tell us about those. We don't see that as a means of avoidance at all. So there's kind of corroboration even from HMRC, look, these are okay with us because they work slowly and over time. And so we're kind of okay with that. We've called them before the Andrex of inheritance tax planning because their softness is their strength.
Lovely. Good one.
I didn't get paid by Andrex or whoever makes those toilet rolls.
Very important to emphasise. Thank you.
It is.
So we have a question from IFA Paul Brown, who's from Ascot Lloyd. It's another detailed one. So leading up to 2022, were bonds actually a client's riskiest asset given the low rates we'd been locked into for years? How does this impact longer term thinking on portfolio construction? And should we have seen this coming and revised the risk assessment of bonds before this happened?
On that, I would say clearly a very relevant question with what we've seen happen to fixed interest investments. However, it is beyond the scope of the white paper. So what I'm more than happy to do is take that back to colleagues at HSBC Asset Management and get a detailed response for the questioner.
Lovely. I think maybe it might be the same for the next one, but I'm going to ask it from Rahit Rahela. I'm sorry again if I got that pronunciation wrong. I'm terrible with pronunciation. So the returns expected from troppy markets is reducing, and yet we are living longer. What is the solution to this paradox? What is the outlook for bonds and fixed interest? And are there any products which provide good returns and volatility management?
Yes, you're right. That would be the same. So very
Yeah.
happy to take that back to asset management and they can catch up.
Perfect.
That longevity point, though, is obviously quite important. You know, that book's out the 100-year life and all of that. It's been out for quite a while now. So I think that fact, just picking one bit of that question, without in any way dismissing the importance, the primary importance actually of, you know, the investment performance and the relevance of that investment performance to your end financial goal. But over time, I think that message that comes, and everyone will go, yeah, we know that. It's just to say, look, I'm a great believer in time in the market rather than trying to time the market. So remaining invested, remaining aware that you have a financial plan and that there will be so-called bumps in the road, that volatility point, but not to make emotionally charged decisions. That, you know, make decisions to come in or out of investments, of course, but don't do them based on fear, as it were, and short-termism, you know, remaining in the market. So I think the advisor has such an important role to play there. You know, when we look at advice alpha, and there's been many studies on that, most see that around 50% of that alpha that comes from the advisor's know-how comes from behavioural coaching. A chunk comes from making those smart choices that we've been talking about. You're making the right choices about where you put your money in and where you take your money from and how you pass your money on, absolutely. But the majority of it comes from behavioural coaching, and that is this thing about just encouraging people to see it's a long-term approach, to know what the goal is, and to keep reviewing your plan with that in mind and not make emotional decisions. So I didn't really give an answer to that, but I felt it needed to be said in the context of that longevity point as well.
Yeah, definitely. No, that's a really interesting one. I've definitely had experience myself of nearly making a knee-jerk reaction and selling a load of shares at the beginning of lockdown.
Oh, but we all do, don't
Terrible.
we? I mean, it's and the reassurance you get. Some of that other researchers also discovered the importance of being reassured by an advisor, and the fact that if you've got an advisor that you trust, how important that is to be able to pick up the phone or however you communicate with your advisor, have a meeting, go on Zoom, whatever, and just have that conversation to get some reassurance, to discuss it. It's like so many things when they're stressful. To be able to talk it rationally takes the stress out of the situation. And you might still make that decision, but you make it rationally. And it's so important. You feel reassured. It's a really important consequence of financial advice done well.
Yeah, definitely. No, totally agree. So we have another question from Eleanor Robertson, who is a financial advisor at Staddon Forbes. How likely do the panel believe a bail-in is in the UK?
Bail-in. Oh, sorry.
Bail-in. Sorry, that's
Right.
the way I said it.
Any thoughts on that one?
What is a bail-in? Sorry, that's me. I'll be open. A bail-in. Sorry, I can't answer that because I'm too stupid to know what a bail-in, as opposed to a bail-out is, I suppose.
Yeah, I don't know. Mark, do you have any thoughts on that?
No, it's
We'll
not.
have to come back to Eleanor on that, I think, perhaps after the webinar.
Yeah, that's an interest, and I'd like to be. I honestly mean that without being in any way patronising. I'd like to give that some thought and to ask other people, what is a bail-in? How does it work? Define it. Elevator pitch. What is a bail-in?
We'll go to our economists and
We will
see what further detail they can provide.
Perfect. So thank you for
Apologies
that, Eleanor.
for
We've
that.
learnt something
Yeah.
today.
Well, we've learnt we need
Always
to
a
learn
school day.
something. Yeah.
So Harry Katz asks quite a long question. So he's a consultant and retired IFA. I find the charges on insurance bonds to be rather high. In addition, there is a life fund tax charge. The asset management charges remain reasonable. Compare this to an investment trust ISA held on a reasonably priced platform. The investment can be fairly easily switched to another platform, hardly possible with a bond, nor are there any issues with top slicing in an ISA. How do you respond to this?
Well, that's quite an interesting one, isn't it? Because, yeah, at face value, absolutely. ISA's nice, on platform, cost effective. With the platforms, you've got access to lots of investment funds to choose from. The thing that immediately comes out to me on this one is what you have with ISAs is you've got that 20,000 a year limit. So when you've got significant amounts of investable capital to place, obviously with your ISA, you can only put it £20,000 into the ISA. Lots of advisors feed into ISAs from general investment accounts, but now, of course, with reduced CGT coming up and reduced dividend allowance, that strategy probably needs to be re-looked at. With the bond side of things, with the current environment of open architecture bonds, there are a number of providers out there that certainly have very competitive pricing available on their bonds, where they can be had on or off platform, depend upon what's right for your clients. You've also got the ability to hold ETFs, investment trusts, as well as a range of funds. And something else that's quite useful, I think, on helping to reduce tax is certainly those people that are taking income out of their bonds. Advisors can put together an income strategy that distributes dividends into the bond because, as Tony mentioned, there is no tax on dividends. So I think for larger investment amounts, the potential tax benefits of the bond, which we've touched on, and the intergenerational scenario of sending it across to the next generation, your loved ones, in the trusts that are available, still make them very much something to be considered, but it's definitely a different level of investment amount in a bond than it is to an ISA because of that £20,000 a year, which doesn't look as though it's going to be increasing anytime soon.
No, in fact, there was some fear that it will be reduced even because of the costs. And of course, we've had pensions which have escaped again, as it were, any kind of change. I think Mark's answered that sort of question perfectly, but I think that it's a really important point that we consider when it comes to wrapping investments. If it's important, then you look at quite clearly the so-called no-brainers first, and that would include pensions and ISAs, and then beyond that VCTs and EIs. So Harry, hope you're well. Haven't seen you for ages, so nice to hear from you. Basically, once you get beyond those, though, then that's where we need to apply current thinking and current tax policy into our thinking to make the right decisions. Mark mentioned that point, the level at which you consider it, 20,000 once you've got beyond your ISA. But once you get beyond that, when do you consider a bond as opposed to a collective investment? Because the GIA, if you're on platform, unwrapped investment seems the obvious one to go for. You can get dividends tax-free up to your dividend allowance, but that's coming down. Get dividends, capital gains tax-free up to your CGT exemption, but that's coming down. What does that mean in terms of thresholds above which, broadly speaking, you should consider wrapping the investment to get a better longer-term tax outcome? And effectively, you can just go, well, actually, whatever you were thinking of now, it reduces by 50% next year. Because if you were thinking X gives me about 50-odd thousand, 3.6% FTSE yield, 50-odd thousand will give you a tax-free dividend this year. So next year, if that tax-free dividend level is falling by half, then the capital amount that generates it will also fall by half. So if you're thinking thresholds to get tax-free dividends, if you're thinking 56,000 this year, you're thinking 28 next. And guess what? You're thinking 14 the year after. So I think whilst the thinking that you apply to determine is it worth going into a tax wrapper beyond the tax no-brainers remains the same, actually. The threshold above which you should, from a tax standpoint, consider it is falling dramatically from next year and again the year after that. And I think that's the point, isn't it, really? That's our point, really.
Yeah.
I think that the reconsideration because the thresholds have dropped.
That was a lot of maths for me, but
A lot
thank you.
of maths, right.
Mark, did you have anything to add on that?
No, nothing further.
So we have another question from Steve Napier at Bloomfield and Associates. Given changes in tax next year, how do you see advisors viewing investment bonds versus general accounts?
well, it's a lot of what we've just
Yeah.
covered there, isn't it?
Yeah.
That with the investment bonds now, the fact that you have got nothing to take into account from a CGD perspective all the time that the money remains in the bond being invested, I think makes them far more attractive than they have been in recent times.
Yeah, I think above a certain level. I think that's the key thing. Is even Mark would agree. You know, if you can get your income and your capital gains completely tax-free out of the bond, you don't need the tax deferment that a bond gives you. You might choose a bond because you want to put it inside a trust. You might choose a bond because you like its simpler administration. Not denying that at all. But from a pure tax standpoint, you would say there's no point in the bond if the income and the gains are going to be tax-free, because you can't get better than tax-free. You know, you might end up with them tax-free if you had an offshore bond and you would no tax when you withdraw your money from an offshore bond, which is possible in certain situations. But where we are now is that with those allowances and exemptions coming down, that's the key, the threshold where you should, I think, from a tax standpoint, consider a bond has dropped. And the point that Mark reminded us of course, is and the administration point for those of you. What's important to you, client? I don't want to pay as much tax, and I really don't want the faff of filling in tax returns and telling HMRC. Those two factors should lead you to say, well, we should have a look at investment bonds, but probably not, you know, below 14,000 in a couple of years' time, which is quite a low bar for many clients of advisors. That's the point, I think. It brings bonds into consideration much earlier.
It does. And it's not just the investment side, isn't it? It also depends whether you want a structure that can change as the client's investing life cycle changes.
Good point, yeah.
And potentially wants to go on intergenerationally. Because a lot of the bonds nowadays, you can have multiple lives assured, so that after the original policyholders have passed away, actually that structure can keep going on, not ad infinitum, but for many, many years, depending on the age of the lives assured, for the next generation.
Oh, completely.
Which I would suggest very few products actually enable that.
Oh, yeah. So, I mean, I had a question last week, actually, on capital redemption bonds without a life insured. So you have more constraints within them as to what you can have inside them and how you use them. But the multi-life approach that Mark gives you that with an investment bond. And I would just mention another question that came up to us last week, and we touch on it now and again when we discuss that, is, say, with an offshore bond. And I'm not saying onshore bonds are better than offshore. I know you'd want me to say that, but you know, they are for some people, they aren't for others. But if you have in mind the offshore bond gives you complete tax freedom as you go along, nothing's changed there either, by the way, then I'll withdraw it tax-free, then that's the beware point of you have to look ahead and go, what is your situation going to be when you withdraw it? If you withdraw it in small bits and you're a non-taxpayer and you've organised your other tax life to be no income, then it may well be possible to take bits out within your personal allowance. One thing I would also mention is that, or assigning to a non-taxpayer, basically someone with that allowance available. If you think, but I'll go and live abroad, there are very few places, if you're going to be a proper tax declarer while you're abroad and not a tax evader, where you don't have a tax liability on investment bonds. And there are one or two jurisdictions, surprise, surprise, where you might not have paid as much tax abroad, but since we have exited the European Union, you will now. The one exception I would say is if you go to Australia, then so you might have a few. Matt Hancock might have a bond and he's staying in Australia, because if he had an investment bond and stayed there for a full 10 years, the gains are completely tax-free. There you are. Tax freedom in Australia on investment bonds.
Well, I would like to go to Australia anyway. So.
Who wouldn't? At this time of year. Yeah.
So we have had some more questions, but I'm afraid that's all we've got time for on this webinar today. So although one last question was, where can we obtain a copy of the white paper? So that brings me on nicely to my final point. Mark, I believe we are going to send out a link to the white paper when it's available, along with this webinar has been recorded and will be available on demand. Is there anywhere else they can obtain a copy of the white paper when it comes out in mid-December?
Yes, certainly. The easiest way is to email us at bondbdmsupport support@hsbc.com. So bond BDM support@hsbc.com. But we will liaise with you so that it's available with your on-demand section of the website.
And we'll send out that email address as well so that they can contact you. Okay, well, that is all we've got time for. I'm so sorry. But thank you so much to Tony and Mark for joining me today. I've really enjoyed the discussion. I think it's been really interesting. And thank you to our viewers for sending in loads of great questions and participating and watching. As I said, the webinar's been recorded. It will be available on demand on the Money Marketing website. It will be sent out to anyone who's registered before this webinar. And as I said, we'll also have a link to the white paper to download when it becomes available. Do also check out all our other great content on the Money Marketing website, as well as following us on Twitter, LinkedIn, Facebook and Instagram. Thank you so much for joining.